Hey everyone, in this video I'm going to answer which stock I think is a better buy, ChargePoint or Plug Power. Now to answer that question, I'm going to compare these two across several critical financial metrics, including valuation. So I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. So let's get right into it, starting with a look at ChargePoint. So one of the reasons ChargePoint highlights that it makes an attractive investment is that electric vehicles are projected to be 9.9% of new vehicles sold in 2025, 29% of vehicles sold in 2030, and so that creates a massive growth opportunity that needs to be fulfilled, and ChargePoint is an excellent position to benefit from that growing installment of electric vehicles worldwide, because those electric vehicles need to be charged. So the cumulative EV charging infrastructure investment in the United States and Europe is projected to be 60 billion by 2030 and 192 billion by 2040. So the industry is growing quickly, to be sure, and it's going to grow to become a massive market, and that's one of the main attractive opportunities, one of the reasons to invest in ChargePoint stock. Let's take a look at Plug Power. Now, Plug Power, one of the reasons why Plug Power's profit margins have been limited or constrained of late is because it's been outsourcing a lot of its energy sales, and management is highlighting that as its Georgia manufacturing facility produces at its full capacity, that's expected to cut their fuel margin loss by as much as half from the second quarter of 2023 to the fourth quarter of 2023. Now that remains to be seen if the company actually achieves that target, but that's what management is aiming for here with the increase in its own production of hydrogen fuel. Also, Plug Power is addressing a massive market opportunity as well. It thinks that its large-scale stationary unit market orders across multiple end markets will open a $1 trillion plus addressable market. Plug Power is seeing meaningful demand for EV charging, prime power, data center backup from Microsoft, Energy Vault, and their pedestal customers. So they too see a massive market opportunity ahead. And certainly, when I'm going to look at revenue in just a little bit, you can see that sales are proving that there is a massive market opportunity. So I mentioned earlier a look at revenue. Now what I have here in the chart is Plug Power and ChargePoint in the orange, Plug Power in the purple, and this is their revenue growth over the last several years. And you can see phenomenal growth here in revenue from both Plug Power and ChargePoint, growing revenues rapidly over the years. Revenue growth is not the question mark for these two companies. Revenue, sales, they're existent, they're growing, but the difficulty is in effectively growing these sales. And that's where I wanted to highlight this next chart here. Is what I have is their operating income over the trailing 12 months. ChargePoint again in the orange and Plug Power in the purple. You can see they're headed in the wrong direction, and quickly, right? They're losing a lot of money, and their losses are only increasing with more revenue. So it's not like they're growing revenue and that's achieving economies in scale and they're reducing their losses on the bottom line. That's not the case. They're growing their revenue, and with growth in revenue, they're just losing more and more and more money on the bottom line. 364 million in losses for ChargePoint, 777 million in losses for Plug Power. Again, these two companies continue telling a story that at this point or this point in the future, we're going to be profitable and we're not going to lose so much money and this and that. However, if you look at the numbers, they just keep losing more and more and more money on the bottom line. And there's always a story, an excuse for why they weren't able to achieve a previously stated target. And it's a similar story for cash flow from operations. You can see it just moving in the wrong direction quickly with Plug Power losing $1 billion in cash flow from operations in its most recent trailing 12 months, and the slope of the curve increasing in the wrong direction as well. ChargePoint losing $323 million in cash flow from operations in its most recent quarter. And if we compare these figures to revenue, it looks like Plug Power's losses look even worse because they're losing more money in trailing 12-month cash flow from operations than they're bringing in revenue, while ChargePoint is losing a lot of money in cash flow from operations, but it's less than the revenue that it's bringing in, making it look proportionally better than Plug Power in this metric. So with these companies losing so much money on the bottom line and bleeding cash flow, I wanted to compare them on how much cash they actually have. And in this metric, Plug Power has more cash at $579 million compared to $233 million for ChargePoint. But that doesn't mean that any of these two are in an attractive position here, because if you compare how much cash they have with how much cash is going out of the business in the trailing 12 months, then you'll realize that this cash is not going to last very long, and they're continuously going back to investors and asking investors for more and more and more money so that they can continue investing in the business, continue growing the business. At some point, I think investors are going to grow fed up with these companies and say, you know what? We're done giving you more money. Why don't you try and run a sustainable business? Stop investing so aggressively in growth and try to manage the business more sustainably. At least reduce those losses on the bottom line. Grow slower if you need to, but grow more sustainably. And I mentioned they keep going to investors, and you can see that here with Plug Power, average diluted shares outstanding. The company's more than doubled its average shares outstanding from less than 300 million in 2020 all the way up to 598 million, diluting shareholders aggressively, while ChargePoint is also diluting shareholders from less than 300 million shares outstanding up to 355 million shares outstanding. It's not diluting shareholders as aggressively as Plug Power is. Similar story when you look at long-term debt. Both of these companies are tapping the debt markets. ChargePoint has long-term debt of $295 million. Plug Power is better in this metric. It has reduced its long-term debt down to $198 million. Finally, I wanted to compare these two stocks on valuation, and the metric I chose to use is the forward price to sales ratio. And according to this metric, ChargePoint is less expensive at a forward price to sales of 1.2 compared to Plug Power trading at a forward price to sales of 1.986. Each of these two stocks are down considerably from their peak valuations. Nevertheless, I wouldn't say that these stocks are a bargain or that there should be a buy on the dip. In fact, I would prefer not to own any of these two stocks. But if you were to force me and I had to buy one of these two stocks, the one I would buy would be ChargePoint. It's selling at a cheaper valuation, and its metrics in terms of revenue and cash flow from operations and the relation to those metrics is more favorable compared to Plug Power. So ChargePoint would be my choice between these two. But before I let you go, if you've gained any value from this video, which you probably have if you made it this far, I would really appreciate if you subscribe to my channel. It'll help me create more videos just like this one. Thank you for watching.